Hello friends, my name is Mahesh. I am from Hyderabad. I born and brought up in Hyderabad. Coming to my education qualification, I completed
Bro,
masters in
one
geography,
last
PG College of
presentation.
Management
Afterwards, I will
in
come.
finance domain.
If you
Coming
want, you
to
can go.
my hobbies are playing
Fetch
cricket,
will be
watching
over.
TV, spending time with my
No, no, no.
friends.
You go.
Coming to my strength is I am a
I
very
will come after.
self-motivated person. I believe in myself. I work in under pressure also. Coming to my weakness are I have no weakness, but I have easily anger when anyone lies when anyone lie. Coming to my work experience, I have 2 years of work experience in Wipro Private Limited company as a senior associate. My role and responsibilities are I work on a Wemo project. Wemo is a self-driving car, driving car. We have to give the connections to the driverless car. Coming to this topic, uh, what is derivatives? Derivatives is an contract between two parties. Buyers and sellers are contract at a place. Uh, Next part.
Yeah.
Uh, Derivatives also it's a underlying assets. Understanding some examples are there. It is a financial contract between two parties to trade and assets at future date at the pretend price and whose value derives from a dependent on the value of underlying assets such a commodity, currency, or securities. In derivatives contract, there are two financial contract and non-financial contract. In financial contract, we have uh, equities and bonds, and non-financial contract in uh, commodities and currency weathers. There are in derivative contract there are four types are there: forward, future, option, and swaps. Next slide. In derivatives are used for speculating and hedging the risk associated with fluctuating price of assets. Like hedging means reducing the risk. When we know the if we get any if we are taking any share some shares, what we know the value will the price of the share will be declined. We know the here is the risk is there. How to reduce the risk? When we are using that hedging for reducing the risk in derivatives. Derivatives can use it to hedge if market moves exactly opposite to the expectation. When we accept the price will high.
Yeah, okay, Mahesh. So what's like you want here?
Yeah, this only. In hedging, when we accepting the price will opposite, when we thought our the prices will increase, the share price will increase, but unfortunately the share price will opposite. We thought accepting exactly opposite to their expectations. When share price will decreases, that time we reduce the risk. We sell the shares or we sell their shares that time. Speculate means derivatives can be used participant to speculate and to make a profit with if the market moves as expected by them. When we accept the share price will increase. Uh, when we accepting the market will goes upper only. That time the speculate will happen. Next. Functions of derivatives like price discovery, transfer of risk, hedging risk, lower transaction cost, higher leverage. Next, what are the advantages and disadvantages in derivatives? In derivatives, advantages and hedging risk. When we know the we getting a huge loss, our that time we reduce the risk that time, and uh, in advantages we know the limited loss and high profit will be in there in advantages. like lower efficiency, market efficiency, lower transaction cost. In derivatives, in future and options contract, when we know the if we are taking any share price, we have uh, less risk, but we get more profit. Uh, what are the disadvantages are there? High risk, counterparty risk, speculative features, and requires expertise knowledge. In disadvantage, high risk also be there. When we know the risk is there, but we are holding the same position, we get so much huge losses also. And counterparty risk also there in forward content. Example, we contract with the opposite party, but opposite party will decline the contract. That time also we get the losses. And next, forward contract derivatives, understanding and applications. In forward contract means agree, a contract. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price on a future date. Forward contract means we are contract to future date, but today we have settle the future contract. Like uh, we know, if I know the potato is increases in next year, I know, but we have contract with market, like next year also same price you will be give the same potato price. If the contract will agree, that contract is forward contract. The primary purpose of forward contract is to manage risk. It enables the parties to fix a price and protect themselves against future price fluctuation. Actually, forward contract in 17th century, forward contract will have started when uh, Europeans knows the rice will be re- reduces in future, so they have contact with markets. That time forward contract will be started. Next, there are key features of forward contracts are customizable, no standardization, no intermediary. In forward contract, there is no intermediary between military person. There are contract between only two persons only. They, if their contract will accept, but it's a risk also there when other party will know they decline the contract also. Right. First, customizable risk. Forward contracts are customized to meet the specific needs of the parties involved. Uh, like if the no standardization, unlike futures, which are standardized contracts traded on exchange, forward contracts are privately negotiated between the parties involved. There is no futures are involved in the forward contract. In exchanges also, like exchange trade in NSE or BSC. Next, the advantages and disadvantages of forward contract. In advantages, like customizable, flexible, uh, regulations. And disadvantages, no standardization, counterparty risk, limited liquidity. Next, forward contract between coffee shop owner and coffee farmers. The situation the situation, a coffee shop owner wants to ensure a stable supply of coffee beans at a fixed price. The coffee bean farmers wants to guarantee a buyer for their crop. The solution: The owner and the farmers can enter into a forward contract which specifies the price, quantity, and the delivery date of the coffee beans. Result: the owner looks in a lower price, ensuring stable cost for their businesses. The farmers have guaranteed demanded for their crop, providing stability to their business. In this example, the coffee owner shop wants the supply of coffee, but in farmers have huge demand, uh, and the coffee shop wants the uh, fixed price, like in every year. They, if they are contract and they like price, quantity, and what are the delivery date, how much the quantity want. If the contract will happen, the farmer will sell their coffee beans to the coffee shop. And counterparty risk also is there in previous example. If the farmers knows the in the next year the coffee beans will increase the huge demand, so they decline the contract also. Conclusion: forward contracts are, why not forward contract, why not forward? Liquidity risk also there, default risk also there, and no regulatory involving also there. And way to futures. Next bro. Future contract definition and function. A future contract is a legally binding agreement to buy or sell a specified asset at predetermined price in the future. Discover how these contracts functions and their significance in their risk management and price discovery. Standardization, expiry date, trading platform. In future contracts having predefined terms including contract size, delivery date, and quality uh, specification. In expiry date, in future contract we have the expiry dates also there. If you and exchanges are counter intermediary between buyers and sellers. Each future contract has expiry date after which trading ceases. Trading needs to manage their positions before these days. If we want any buy or sell the shares, in future contract, if in future, the, it's a expiry date also there, like 1 week or 1 week or 1 week. Utilization future contract in different industries. In agriculture, future contract play a virtual role in managing price risk for agriculture commodities such as wheat, corn, and soybeans. In energy related future contracts enable business to manage price fluctuation in crude oil, natural gas, and electricity. Finance. Advantages of trading futures: hedging opportunities, liquidity, leverage. Future contracts providing a platform. Disadvantages: futures, exposure, margin call, complexity. In exposure, engineering in futures trading exposes participants to various risks, including market volatility, leverage risk, and counter specific risk. In future trading, we have market volatility risk also there, high leverage risk also be there, and counter specific risk also there. margin calls. Unprofession price movements can trigger margin calls, requires traders to provide additional funds to maintain their open future positions. Complexity. Understanding the understanding the intricacies of futures markets and the complex factors that affects price requires continuous learning and analysis. Understanding margins in future trading. Initial margin, the amount deposited by a trader to establish a future position, ensuring the commitment to the trade. Variation margin, funds transfer between the traders and the brokers to account for a profit or loss on the future position due to price fluctuation. Maintenance margin, the minimum amount of equity required to avoid a margin calls and ensure the continuous maintenance of a future positions. Next. What are option contract? In derivatives, the terms option refers to a financial instrument that is based on the value of underlying securities such as stocks, index, and exchange traders funds. Options contract that gives the holders the right but not the obligations to buy or sell an underlying assets at a specified price before at the expiration date. Next. There are two main types of options like call option and put option. In call option, uh, we know the call option, we think the price will increase. We take buy option, call option. In put option, we think if the price will down, we take put option. We sell the shares that time. Next, let's look at three scenarios of profit and loss in put option. In option buying and call option, put option, in option buying profit and loss, in option selling profit. If the SBI price is 490, when the price will increase, we get if 10 like price will increase, we take buy option in put in option. And if we price will decrease, we take put option. Example here, call option, put option. Buyers of a call right to buy but not obligation. Seller of a call obligated to sell. Call value increases when underlying asset increases. Investor look for a price rise. Potential gain is unlimited. In call option, risk is less, but unlimited profit is there. Buyers of put right to sell but not obligations. Seller of put obligated to buy. Put value decreases when underlying assets increases. Investor look for a fall in price. Potential gain is limited. In put option, the seller like investor think the price will fall and gain is limited in put option.
Yeah, Mahesh, good presentation. You have given lot of information to us. Yeah. Okay, Mahesh. If you want to ask any questions to us, you can ask. I think you want to say anything?
మహేష్ ఇది సెల్ఫ్ ఇంట్రో చెప్పినప్పుడు వీ